Hello and welcome. If you're a focused learner trying to really make sense of the financial world, well, you're in the exact right place. Today, we're taking a highly structured journey to completely demystify how mutual fund investing actually works. We're going to cut right through the noise, skip the complicated jargon, and just give you a crystal clear understanding of the foundational principles you absolutely need to know in this explainer. Okay, let's dive into this. Here is our roadmap for today. 1. Emergency fund first. 2. The 500 rupee investing myth. 3. SIP versus lump sum. 4. Understanding the NAV illusion. And 5. Your biggest investing advantage. Now, personal finance can seem absolutely huge. From SIP basics to tax saving and retirement planning, there are literally hundreds of topics. It's vast and honestly a bit intimidating. But hey, don't worry. You definitely don't need to memorize 365 things today. We're zooming in on just 5 focused beginner principles that act as your foundation. Step 1, emergency fund first. Right, so before we even talk about growing your wealth, we've got to talk about protecting it. You need to hold off on your investing journey until this one fundamental piece of the puzzle is securely in place. Skipping this, well, it's a trap that catches almost all beginners off guard. Before investing for any long-term goals, you absolutely must build an emergency fund that covers several months of your essential expenses. Why does this matter so much? Because life happens, right? The whole point of this safety net is to stop you from selling your investments unexpectedly during a financial emergency. If the market is down and, say, your car totally breaks down, you do not want to be forced into panic selling your mutual funds at a loss just to pay the mechanic. Secure the safety net first so your investments can actually do their job and grow uninterrupted. Step 2, the 500 rupee investing myth. Once your safety net is built, people often hit this massive mental roadblock. 500 rupees. There's this huge misconception that you need a pile of cash, like 10,000 rupees or more, just to get your foot in the door. No way. You can start a systematic investment plan, or SIP, with as little as 500 rupees a month. I mean, that's literally the cost of a couple of coffees. The barrier to entry is completely shattered. And here's why that low entry point is just so incredibly powerful. Starting early is vastly more important than starting with a large amount. Getting off the sidelines right now with 500 rupees a month is going to serve you so much better than waiting 3 years until you've saved up a larger lump sum. Your money desperately needs time to grow. Actually, getting started is the hardest part. But once you do, time completely takes over. Step 3, SIP versus lump sum. Now that we know you don't need a fortune to start, how do you actually put the money in? Well, a SIP, systematic investment plan, is kind of like a steady tap. You invest a fixed amount regularly, which spreads your purchases out over time. On the flip side, a lump sum is like emptying a bucket all at once. You take a large chunk of capital and just invest it on a single day. So naturally, you're probably wondering, which one is better? Well, there isn't one universal right answer. The best method for you completely depends on a few personal factors. It depends on your current financial situation. Do you have a steady monthly salary or did you just receive a big bonus? It depends on your specific financial goals, and it heavily depends on your risk tolerance. An SIP can feel a bit safer because it smooths out the market's ups and downs over time, while a lump sum puts all your money to work right away, but exposes you to whatever the market does the very next day. Step 4, understanding the NAV illusion. As you set up your investments, you're inevitably going to hit some industry jargon. You'll see this metric called NAV. Maybe one fund is at 20, another at 200. It leads to a super common question. Is a lower NAV always better? Does it mean the fund is cheaper? Not necessarily. Let's clear this up right now. NAV stands for net asset value, and it's simply the per unit value of a mutual fund. Think of it like a price tag for a single slice of a really large pie. So the crucial point is that a lower NAV doesn't automatically make a fund a better bargain. It just means the pie has been sliced up differently. Do not get caught in the NAV illusion. Instead, I want you to guide your focus entirely to what actually dictates long-term success. Focus on whether the fund's strategy actually matches your specific goals. Focus on its overall performance over time. Those are the real metrics that determine if your wealth is growing, regardless of whether the initial per unit value was 10 or 1,000. Step 5, your biggest investing advantage. Okay, we've covered the safety net, the entry cost, the methods, and the jargon. Now it comes down to one undeniable truth. Take a second and really absorb this quote. Your biggest investment advantage isn't money, it's time. If there's one thing you take away from this entire explainer, let it be this. The earlier you start investing, the longer your investments have to grow. Your clock is ticking right now, and that clock is absolutely the most valuable asset in your entire portfolio. This brilliantly illustrates how the math works in your favor. When you combine small, consistent investments with the magic of compounding over many years, the results are just staggering. Compounding essentially means your money makes money, and then that new money makes even more money. It's often called the eighth wonder of the world for a good reason. But it requires a long runway to truly take off. You've got to give those tiny amounts the years they need to multiply. So, what does this all mean? We end with this question. Are you ready to put time on your side today? We've stripped away the excuses here. You don't need a huge lump sum. You don't need to understand complicated jargon like NAV. You just need an emergency fund, a willingness to start small, and the patience to let compounding do the heavy lifting over the years. The only thing left to do is take that first step. Stop waiting for the perfect moment, start your journey, and let your time start working for you today.